Well, I think it's time to do an update on the housing market. Something that I and many other people have been, monitoring throughout this past year was the mortgage forbearance program that the U.S. federal government put into effect originally with the CARES Act. This kind of stuff also applies to renters. We of course have the eviction moratorium, so people who aren't paying their rent are not getting kicked out, and so therefore you don't have a big supply of rental units hitting the market, and therefore rent has stayed high. It has not collapsed, which probably should have if you have a bunch of people who can't afford to pay their rent. Either those people get evicted, and nobody would be able to afford the rent, and so rent would have to fall in order to get people to actually move into those apartments or end houses, or they would just go to the people who are already in there and say, okay, we're going to have to lower the rent because nobody can afford to pay what we were earning on this unit in the past. Mortgages, and so that's in the case of renting. With mortgages, you're not really going to have banks taking a haircut and just modifying people's mortgages and forgiving the value of the home and lowering their payments that way. You don't get that so much with banks, because when you have a mortgage, you agree up front, okay, this is the amount of money I'm going to pay back to you, and it's a 30-year contract, whereas leases are typically year to year, and if you break that and modify it because of some extreme circumstances, that's a little more reasonable. And so what we would have expected to see last year without this forbearance program is that when they shut down the economy and all these people lost their incomes, and even if some of that income was replaced by stimulus checks and much more robust unemployment insurance and a lot of big unemployment checks, for most of these folks, or a lot of these folks in the economy, would not have replaced enough of their income in order to continue paying their mortgage. And so hence why the forbearance program was created. It essentially just says, hey, we're going to put off all this money that you owe. You're not going to have to pay for a while because we understand that you're not going to, you don't have the ability to pay right now. And so just worry about that later. And they keep kicking the can down the road. And originally the idea was that, well, when forbearance ends, you have to pay all that money that you didn't pay before in one lump sum. Which, that obviously would create lots of problems because nobody has any savings in this country. And so if anyone has to pay a lump sum of anything, that's going to push them into bankruptcy. So now we're at the point to where they're saying, well, if forbearance ends, you're just going to resume your payments, the old thing, and they kind of just kick the can down the road on your mortgage. You just have a gap where you didn't pay, and then they tack that onto the back of your mortgage. That seems to be, even though that's a little more complicated to try and work out, that seems to be what they're trying to do with people if they actually come out of forbearance. But in the absence of this forbearance program, what would have happened was people would have lost their jobs, they would have stopped paying on their mortgage, and they would have been foreclosed on, and the air would have come out of the housing bubble. Housing prices would have come back down to earth. They would become more realistic, more in line with where the real value should be. Of course, historically, housing prices in the United States just tracked evenly with inflation, meaning that housing prices were static in real terms. Housing is not just supposed to just go to the moon like it has over the last 20 years, twice. First in the run up to 2006, and then now pretty much. I guess the bottom of the market was 2012 to 2021. Here we are again, to the moon. And so it's not a great buying opportunity. It's not great if you want to buy a house. It's great if you want to sell it. If you've owned your house for 20, 30 years and you're saying, you know what, I'm going to sell my house and downsize or something, this is a great time for you. But other than that, if you're somebody who actually wants a home, this is horrible. Now, as I've gone over many, many times, the reason why prices got so high to begin with was because the Fed, printing lots of money, keeping interest rates really, really low, increased the buying power of people in the market to buy a home. You can afford a lot. You can, because when people are buying a home, they're always looking at, okay, what's my payment going to be? The higher your interest rate is, the lower you can pay on the principal of a mortgage, and so therefore you have to get a lower priced home. And as interest rates fall, the interest portion of that payment, let's say you can afford $1,000 a month, if half that, or actually that's really extreme. Let's scratch that. Whatever the more of that $1,000 a month that's taken up by interest versus principal, well then the less money you're going to have, the lower budget you're going to have for the price of the home. But if interest is as close to zero as possible, then as much of that $1,000 a month budget can be spent on the house itself, and you can afford a bigger and bigger prices. And so therefore, when you have really low interest rates, that's why you get these massive housing bubbles. And so a lot of people, and I think myself included, to a large extent, although I'm kind of, once I've seen the numbers, now I'm a little, I'm much more skeptical of this idea. People have been anticipating, okay, well, once forbearance ends, all that they've done is kick the can down the road by creating this forbearance program on the housing crisis. We're going to have a housing crisis, and housing prices are going to collapse just like they did back in the wake of like 07, 08. Just wait until forbearance ends. But frankly, considering that the Fed has been so effective in blowing this bubble, the demand for housing is so extreme right now that even if forbearance comes to an end, starting from in between now and the next 6 months, over the 6 months we're supposed to have, unless there's another extension, a rolling end to forbearance. Different people are going to be losing their forbearance at different times, and therefore they're going to try and sell their homes, and probably not wait to go into foreclosure. And the reason for that is something that Ken McElroy pointed out. He has a really great channel if you guys don't watch him on real estate. He pointed out that right now a lot less people are underwater on their mortgage than they were back in the 2008 period, and so therefore they have much more of an incentive to try and sell their house so that they can get some of that equity that they still have in it out, rather than just sitting in the house and waiting until the courts come and kick them out. And so he thinks once people start losing forbearance, they're going to try and sell their houses. There's going to be a glut of houses on the market because everyone's going to be rushing for the exits, trying to preserve what equity they have left in their home, and that is going to create a buying opportunity for real estate investors. But frankly, considering how insane the market is in different parts of the country, particularly here in Florida, if we have this huge glut, and he thinks that, if I remember correctly from his video, he was estimating that the inventory for the housing market, meaning that the amount of homes for sale could like double. I can't remember if it was exactly double, but I mean it was a very large increase. And you can go back and watch Ken's channel if you want his thing on it. I'm not here trying to just hawk his theory, but he plugged in some interesting numbers, and I don't think that his numbers are not going to be exact, but it's his estimation. And I only bring that up to say that even if he's 100% correct on how many of those houses are getting put in the market, as crazy as things are, that might not even push the prices down, because the Fed has created essentially a limitless demand for housing in this country. No matter how fast they build it, no matter how much the price goes up, people will still pay whatever they can for a home. The money is there. The Fed is printing it, and so the demand for housing appears to be limitless. To me, we're not going to be able to pop this housing bubble from the supply side. I mean, it's possible, I guess, but it seems like it's like a much more daunting task than trying to pop it from the demand side. I think that that's really where the housing bubble is going to have to meet its end if we want to make sure that it's good and dead. If we have this huge glut in even assuming, because there's still the possibility that forbearance is extended again, because why not, right? If the federal government thinks that the housing market's going to collapse if forbearance ends, well, then they're probably going to extend it. But even if they don't extend it, I mean, you have the massive power of the Fed behind this housing market. I mean, look at the way that the stock market has been able to endure every blow that's been thrown at it. Sure, you get little pullbacks here and there in stocks. You might have a bad month. You might have a correction. But then you come all the way, you come back and make new all-time highs every single time. And so I still think the name of the game is don't fight the Fed. Now, that's not to say that I think that housing is a great buy or anything like that, and that it's going to keep going up. What I'm saying is that the trigger that we're looking for is not going to be a sudden glut in the supply of housing like we saw back in starting in 2006 when housing prices peaked. Then they started to come down because there was a glut in supply. Because back then, the Fed was helping them along. That glut in supply was caused by the Fed because the Fed had already pulled back on the demand side. The Fed was raising interest rates. And so therefore, you had supply increasing against a falling demand curve. And, that's how you get falling prices. It was a double whammy. And so therefore, the housing market collapsed as it should have. But this time, you've got the Fed putting the pedal to the metal, and they are, going to try and just ram right through, any spike in the supply of homes for sale in the United States by keeping rates low. Now, what the trigger you are looking for when this trend can all reverse and when the air will start coming out of the bubble, is when interest rates start pushing up mortgage rates, when rates start rising despite what the Fed is trying to do. And I've been talking about this the last couple of weeks because we are starting to see that, though it has not reached critical mass yet. We're not at the point to where interest rates have risen enough to pop this bubble. I just checked. The 10-year is sitting at like 1.67 as of yesterday. Which is down a little bit, but again, you're going to have pullbacks on the way up. It's clearly trending up. We should be hitting 2% at some point in the near future. And if the 10-year is able to sustain a move above 2%, and it looks like we're heading higher, then that would be what would concern me as far as regarding all assets, not just housing. Because if we are able to, at the same time, have rising mortgage rates and, a supply-side shock in the form of the end of mortgage forbearance, well, then you can start thinking about prices starting to come down a little bit. But as is the case with all bubbles, once the price starts to come down a bit, once the price starts to dip, it's going to continue moving in that direction. I don't think that housing prices are very unstable in the United States. We're not just going to get up to a certain high level and then stabilize there. We're going to keep going higher and higher until we start to go down. And once we start going down, we're going to go lower and lower. We're not going to stay at some happy medium. That happy medium is sort of your market equilibrium, and that was destroyed in the United States. Probably before I was born. So I'm more skeptical than ever when it comes to waiting for the end of mortgage forbearance, and I hope I'm wrong. I hope that the bubble bursts sooner rather than later. The longer this goes on, the worse it will be. But even if you have a bunch of people trying to sell their houses because they can't afford to pay for them, and the government's not letting them, not letting them do it anymore, I don't know if that'll be enough. And we still have the possibility that the government just extends forbearance again. Because again, if the government thinks that there's going to be a big issue from this, I think they're going to go ahead and extend it. I don't think that they want to let any sort of economic pain be felt. That's just politically unfeasible. But if you have rising interest rates, it doesn't matter if there's mortgage forbearance. Because people aren't going to be able to qualify for a loan on houses that are that expensive. If your income stays the same and the interest rate goes up, you now can't afford as expensive as a house as you did before. If interest rates go from 3% to 6% on a mortgage, and you were able to before afford a $250,000 house, well, now you're going to be able to you're going to be able to afford a much less expensive house, and that happens to everybody. So as interest rates rise, demand for housing in general, not just on the individual basis, demand for housing is going to fall. And when we have an artificially limitless demand, the demand side becomes what matters. I mean, supply and demand are completely detached. It has no basis in reality, but sadly, this is the system that the Fed has created. So those are my updated thoughts on the housing market and the coming crisis. I'll leave it there for today.